Welcome to another Southbank Investment Bulletin. This time I thought I would talk about energy. So I think this is a really good chart. It's from McKinsey, and it shows us the breakdown of how various forms of energy are used. And here's the big dip in 2020. The entire global economy shut down, and uh, demand for every single form of energy fell, and then it recovered. So the total is going to rise over time, and perhaps the biggest growth factor will be in renewables. But I think it's worth considering that down here you have oil, and oil is going to continue higher until about 2025, and then this chart is from a couple of years ago, and then it's likely to decline. But by the time we get to 2050, oil demand will go from 54% to 48% over the course of that 30-year period. Now, renewables will go from 15 to 30%. Now, that's a big jump. That's a doubling. So we're definitely going to get growth in renewables. But it doesn't mean that oil is going to stop being produced. And we still have all of the issues with how are we going to sustain that production? Because new oil is hard to find. So we're still going to need an awful lot of it between now and 2050, even in a very optimistic view where the role of renewables doubles over the same time frame. So where is that oil going to come from? Well, here's global liquids production by source. And we can see that back in 2000, OPEC was about 30% onshore. And then you had OPEC just on the offshore. Well, I guess when they say shelf, what they really mean is close to shore, offshore. So then that was another 10%, so that's 40%. And then you had Russia onshore, and you had shelf non-OPEC, so that'd be like the Gulf of Mexico and uh, the North Sea, for example, and then you have deep water. So shale has become a really significant factor over the course of the last decade, and it's going to become more of a factor. Oil sands is also going to become a factor, and then deep water is going to increase between now and 2030. This isn't accounting for where the oil is going to come from between 2030 and 2050. So certainly we're going to see a lot of growth in shale and a lot of growth in deep water. But I think deep water is an interesting one because it's not like there's a lot of drilling going on right now. Now, one thing that's important to consider is that 95% of all the oil drilled is economic at between 70 and $75, or well, between 65 and $70. And then if we go all the way back here, that if we just go and look at below $40, 70% of the oil drilled is economic at $40. So when we talk about undeveloped reserves, well, most of the undeveloped reserves are offshore. So we're going to see definitely more investment in offshore. And then we're also going to see a lot more development of the renewables. Now, of course, it's worth considering that oil prices are hovering here around the upper side of that underlying base formation. Between 2015 and 2021, prices had trouble exceeding the $80 level on Brent crude, and since the end of last year, prices are finding support there. Now, I think anyone can see that there's still a clear downtrend. There are a sequence of lower rally highs. and the 200-day moving average is still trending downwards. So in order to demonstrate that we're back in a demand-dominated environment, prices will have to push up through that 200-day moving average. So that's certainly possible. And it's worth considering that the last time that we saw prices holding at reasonably high levels, then that was all the way back in 2011 through 14. So it's not unprecedented that prices stay higher for longer. Of course, subsequently they really collapsed because there was a big supply response. So that's, I think, an important consideration as well, that oil prices have come down. They're beginning to find support, but we haven't got a lot of evidence just yet. But then we have this question about renewables. We have this prediction that the role of renewables in energy production is going to double, but that's going to rely on lots of resources. And in order to meet the demand for transportation and then electricity production, well, we're going to have to see a doubling in the mined production of copper. And copper prices are still trending higher. Now they're hovering here as well around the $4 level, but there's a clear sequence of higher reaction lows. It's going the opposite direction of oil right now. So that's another reason why oil isn't really going to go anywhere, that we're going to have a dual strategy, that even someone who is a true believer in the potential of renewable energy has to at least give some consideration to the fact that the mines don't exist. Nobody wants to build a copper mine. And even if they did, it takes upwards of a decade to do it. Because the problem is that the sources of, or the potential sources of copper are miles from the sea. And you have to move a massive volume of rock to process the copper, and then you've got to transport it to an export facility. Well, it requires roads, railways, and then practically a city worth of people to run a copper mine on of a global scale. And we need lots of those in order to double the capacity for mining. And that's just not happening. Nobody wants a city-sized mine next to where they live. And most particularly, then it could be 1,000 miles or 2,000 miles from the coast. So these are really significant issues for renewables, because what they're really doing is talking about replacing liquids, which are abundant, with metals, which are difficult to mine and process. And this suggests that the enthusiasm for renewables and these ambitious targets set by politicians for emissions to be cut aggressively by 2030, well, they're just not going to happen. It's going to be a lot slower than a lot of people anticipate. But that's not going to stop them from imposing taxes. So carbon emission prices are easing back from the €100 level, but they're still really high. And politicians want to make them higher. They want to stop people consuming energy. And they want to try and force people into renewables. But they just aren't thinking about where are the renewables going to come from, and will they be available at an attractive price? So this is obviously a big question. And then, of course, there is the additional question that interest rates are rising. And a lot of the renewable energy solutions were proposed in a very low interest rate environment. 10-year yields are now bouncing from the 3.5% level. And that suggests that we are in still a tightening liquidity environment. The big challenge for renewable energy is that you have to put the money up front. You get once you build your your solar farm or your wind turbines, that's where all the capital goes. then you get your electricity basically for free afterwards, aside from the cost of maintenance. But you need the money up front. Whereas when you're talking about oil wells, well, yes, it does cost money to drill the oil well, but they become revenue positive very quickly. And then you're selling a resource that expends, so your customer always needs more. So it's a very different kind of business model. Well, uh, the higher interest rates go, the more difficult it will be for renewables. Then we can think about what the oil companies are saying, because they now have the backing of governments because of geopolitical issues. And what companies like Shell and BP are saying is that they're rolling back some of their intensity in terms of supporting renewables, for the simple reason that uh, they don't have to any longer. They've got some cover from governments that they're going to have to increase supply in order to really support the domestic economies. So we've had a bit of a change in the energy sector, and it's going to create investment opportunities. And there will be both give and take, because renewable energy is still likely to double in terms of the energy weighting over the next 27 years. But it doesn't have to happen in the next 5 years. And it does really rely on low interest rates and available credit and reliability of cash flows. And it's going to start getting, I think, priced more in line with the type of cash flow reliability that a lot of the traditional energy companies offer. And that is something I think will unfold over the next few years. I think with that, I'll leave you for today, and I'll wish all the best to all of you.